Good afternoon. On behalf of the Wagner Law Group, this is Steve Wilkes and my colleague Olivia Aber, and we welcome you to today's webinar on the recent SEC risk alert, which dealt with some problems under the advertising rule and related performance reporting issues. We're delighted to have you joining us. We have quite a bit of material to cover, as you can see from our agenda. Slide, please. And we'll try to do that within an hour. We're going to focus on a couple of topics. Which I think have been called out by the SEC. The SEC issued, as many of you know, a risk alert back on September 14th. It was titled the most frequent advertising rule compliance issues identified in OCIE examinations of investment advisors. And I think that alert sort of reminds us that complying with Rule 2064-1, the advertising rule, is very important, always has been and continues to be so. And interestingly, of the various deficiencies that were identified with regard to advertising, 4 of them relate to performance reporting or aspects of, of performance reporting. So today, we'll start off, we'll frame this a little bit. We'll try to contextualize our discussion with an overview of the Antifraud Rule and, and the advertising rule itself. And then we'll move on and talk a little bit about the risk alert. And as I said before, the risk alert talks about the 6 most frequent areas of, non-compliance or problems or deficiencies with respect to the advertising rule. And this risk alert also included some observations that came from the SEC's 26, what they call the touting initiative. The touting initiative consisted of, I think, about 70 exams conducted back in 2016, the purpose of which was to determine the adequacy of disclosures that were made about awards and ranking lists and professional designations. In other words, when people were touting themselves or their firms. And that's where that came from. And because so many of these identified areas, these problems relate to performance reporting, we'll then go on and talk a little bit about some of the specifics on performance reporting. We'll talk about some misleading practices that relate to actual and model reporting, the net of fees requirement, the gross of fees, exceptions. We'll talk a little bit about deduction of model fees versus actual fees. We'll talk a little bit also about portability of performance. In today's day and age, there's so much mobility, with advisors moving from one firm to another, and firms merging and combining. There's a lot of interest, as always, in the portability of performance, the ability to kind of tack on your prior history going forward. So portability really relates to the use of advertisements, either of an advisor's performance at a prior firm or maybe of a prior entity's performance before it merged or changed its identity. And you can do this as long as certain conditions are met. We'll talk a little bit quickly about backtested performance, which typically involves the presentation of hypothetical performance based upon a looking back or a retroactive application of an advisor's strategy. Now, the SEC has not found this practice to be false or misleading. It's very suspicious. It's always treated backtested performance as highly suspect, and we'll talk a little bit about it. Then we'll round out our conversation a little bit with some of the record-keeping requirements under the advertising rule and the benefits or some of the attributes of voluntary compliance with the global investment performance standards, which are, referred to as GIPS. So I think, we'll try to go through a kind of a high level. We'll touch on these topics. They should be thought-provoking for you and give you pause to think about what you're doing and not doing these days at your firm. And I think also in the larger context, I think it's important to remember that whether it's, advertising, any kind of compliance, advertising, performance, what have you, I think we're living in a period right now where, the SEC, the DOL, FINRA, everyone is looking at transparency and disclosures and conflicts and, the duty of care, the standards. So I think a lot of what this is about is getting it right. And of course, there are some distinctions among these agencies as to, how you get it right, but there's really not a question as to whether you should get it right. It's more a question of how. I think that's kind of a framing perspective to keep in mind for this stuff. So I think I'll ask my colleague, Liv, to take us forward and bring us through a little overview on a couple of the larger issues before we get into some more detail.
Thank you, Steve. Section 206 of the Advisors Act makes it unlawful for an investment advisor, whether registered or unregistered, to directly or indirectly engage in any act, practice, or course of business that is fraudulent, deceptive, or manipulative. This is known as the Antifraud Rule. In the 1963 case, SEC versus Capital Gains Research Bureau, the United States Supreme Court held that under Section 206, advisors have an affirmative obligation of utmost good faith and full and fair disclosure of all material facts to their clients, as well as a duty to avoid misleading them. The court also found that the financial advisor's intent to deceive was not relevant and not required by the language of the Advisors Act. The Anti-Fraud Rule is broad and applies to all written correspondence, not just to advertisements. In addition, Section 206, Parens 4 of the Advisors Act grants the SEC the authority to define acts that are fraudulent and to prescribe means reasonably designed to prevent fraud. It is against the backdrop of the Anti-Fraud Rule that we will now delve into the Advertising Rule. Rule 206, Parens 4, known as the Advertising Rule, was promulgated under Section 206, the Anti-Fraud Rule. The Advisors Act defines advertisement very broadly. It is any notice, circular, letter, or written communication to more than one person. It includes any notice or announcement in any publication or by radio or TV, which offers investment advisory services with regard to securities. In general, whether a particular communication or a series of communications constitutes an advertisement depends on all of the facts and circumstances. In applying this standard, the SEC has viewed materials designed to maintain existing clients or to solicit new clients as advertisements. This includes letters, presentation booklets, requests for proposals, radio and TV broadcasts, magazines or newspaper pieces, and certain electronic communications such as postings on the Internet. In recent years, the SEC has put out guidance that statements made through social media may fall within the advertising rule as well. Some examples of communications that are generally not considered advertisements include oral communications that are not radio or TV broadcasts, written communications that do no more than respond to an unsolicited request by a client, prospect, or consultant for specific information about the advisor. Also, documents that relate specifically to investment companies, such as prospectuses, advertisements, or sales materials, will not generally be treated as advertisements. Relevant advertising rule guidance and principles are often discussed in commission opinions, court cases, and guidance updates put forth by the SEC. The advertising rule has 4 specific prohibitions and 1 catch-all provision. The first is the prohibition against testimonials. Advertisements that refer directly or indirectly to a testimonial concerning the advisor or advice, analysis, report, or service rendered by the advisor is prohibited. The advertising rule does not define the term testimonial, but its meaning has been interpreted through a number of no-action letters over the years. In general, a testimonial is a statement of experience with or an endorsement of an advisor. Such statements need not be restricted to the advisor's performance. Therefore, a statement about the advisor's character, for example, may constitute a testimonial. The SEC finds testimonials to be misleading since they will always be presented in an unbalanced manner. The second prohibition restricts an advisor from advertising past specific recommendations. The SEC finds this to be inherently misleading because by their nature, they emphasize the activities favorable to the advisor and ignore those which are not favorable, a practice commonly referred to as cherry-picking. Advertising past performance recommendations is prohibited unless, 1, the advertisement sets out or offers to furnish free of charge a list of all recommendations made within the immediately preceding period of not less than 1 year, and 2, the advertisement contains certain information, such as the name of each security recommended, date and nature of the recommendation, for example, to buy, hold, or sell, market price at the time, the price at which the recommendation was acted upon, and particular text must appear on the first page in the largest print used that says it should not be assumed that future recommendations will be as profitable as those appearing on the list. Third is the prohibition against advertisements claiming that any graph, chart, or formula can by itself determine whether to buy or sell a security or will assist individuals in making decisions. This is prohibited unless the limitations and the difficulties are prominently disclosed. The fourth prohibition is against advertisements that offer purportedly free reports, analyses, and services if there are any conditions or obligations connected with their receipt. The advertising rule also has what is referred to as a catch-all provision. Advertisements which contain any untrue statement of material fact or which is otherwise false or misleading violates this provision. This catch-all casts a wide net, and many questionable advertisements that do not meet the previously mentioned 4 prohibitions may fall into this category. As a general matter, whether an advertisement is false or misleading will depend on the particular facts and circumstances surrounding its use. The following 3 factors should be considered when trying to determine if an advertisement is false or misleading under the catch-all. 1, the sophistication of the prospective client. Consider who the advertisement is being presented to. Is it being presented to a sophisticated client in a one-on-one setting or to a retail investor? Or is the advertisement being broadly distributed? 2, the form and content of the advertisement. All relevant information should be included in the advertisement so that the audience receives an unbiased picture of the advisor's investment skills. Third, the implications arising out of the advertisement is total context. This means that the advertisement should be examined to see whether the audience may infer something about the advisor's competence or future investment results which would not occur if all of the material facts were included. And at this point, I will pass the baton to my friend Steve, who will talk about the risk alert.
Okay, thank you. I will take the baton. So I think it's interesting, talking, the way Olivia just talked about the advertising rule and the anti-fraud rule. Just stop and think for a moment how broad they are, how encompassing they are, and I think that really sets the stage for the potential reach and the implications of getting, of the advertising content that's put out there, because the sweep of these definitions and these regs is extremely broad. It ends up to be a very facts and circumstance test, so we have a lot of, history with SEC no action letters and what have you as our way of kind of guiding forward, but you can never be too sure. So let's talk about the risk alert. It came out back on September 14th. It identified, 6 areas, common deficiencies or weaknesses with respect to the advertising rule. I think it's worth noting that this is kind of a show of this is kind of a show of hand. It kind of shows you where the SEC is these days in terms of putting their resources and some emphasis. So, you know, of these 6 deficiencies, you know, the 3 of them were compliance issues that related to performance reporting. A couple were a little more focused on, you know, past specific recommendations, and one was on record keeping. So let's slide, please. Let's see what we can do there. The first one is, I'm sorry, go back one slide. That was my fault. The first one is on misleading performance results. And by the way, this risk alert, you know, really should be read in concert with and supplements some prior alerts that were done earlier in the year, back I think in February by the SEC. So this is really a continuation of some areas of concern that they've been calling out, but it all relates to, you know, compliance and communications with clients. So the first one that they called out, misleading performance results. And what they're really saying here is what they found from these examinations was that they found advisors that were presenting performance results without deducting advisory fees, and as you'll hear later, that's generally not a good thing unless you meet an exception. They found that RIAs were comparing results to benchmarks, which is okay, you know, kind of a reference point, but they weren't really including disclosures regarding the limitations around those comparisons. Like, for example, if you were advertising a strategy that materially differed from that of the underlying benchmark strategy, you know, that could be a problem. These advisors, you know, included hypothetical and back-tested performance results without really explaining how the returns were derived, and they found that generally it didn't always include potentially material information regarding the performance results. Slide, please. So that was one area they called out. They also were focused on one-on-one presentations, and what they found here was that advisors were advertising, you know, gross performance results, you know, in some actual one-on-one presentations, but they didn't include all the, you know, the relevant disclosures, you know, that the SEC has provided with their staff guidance over the years that might make these presentations misleading. And they also found that when they conducted these, you know, one-on-one presentations, which are clearly subject to the advertising rule, that they didn't disclose that these advertised results didn't reflect the deduction of fees, or advisory fees, I should say, and that client returns, you know, would be reduced by such fees and other expenses. Now, that sounds pretty obvious to us. We're in the business. We think about this stuff all the time. We're advisors. We're legal counsel in this area. But the clients, it's so easy for people to misconstrue and not fully appreciate what is said or not said, and that's why these guidelines have been established the way they have to make it, you know, so clear. Another area was the third area of the 6 was just misleading claims of compliance with the voluntary performance standards. We'll talk about those a little later. Advisors are saying that their advertised performance results, you know, complied with these, you know, certain voluntary performance standards, you know, the Global Investment Performance Standards, GIPS, when it really wasn't clear that the results adhered to those relevant guidelines, and that was a problem. The fourth area is good old-fashioned cherry picking, and they were concerned that advisors might only include, you know, profitable stock selections or recommendations in their presentations or in a client newsletter or on a website, but didn't meet all the conditions under, you know, the advertising rule. So, you know, these conditions, you know, they don't prohibit an advertisement which sets out, you know, a list of all the recommendations made by an advisor during the preceding year, but the advertisement or the list or the information provided, you know, has to have certain specific disclosures about the recommendations, you know, that you have to give the name of each security, the date and the nature of the recommendation, and so on. So there's a way to do it in a way which is not necessarily blessed by the SEC. Slide, please. They also, kind of a related area, but they put it under the label of misleading selection of recommendations. And what they were saying here was that advisors, disclosed past specific investment recommendations, that might have been misleading because they included some but not all recommendations when they were advising or when they were communicating to clients or prospects. And they were doing this in order to illustrate a particular investment strategy, but they didn't meet all the criteria under the advertising rule. They also found that there were, there's a list of fairly specific no-action assurances in some famous no-action letters, TCW Group and Franklin, and they said that the advisors didn't satisfy the representations in these letters, and that was a big cause of concern. Slide, please. And the final point they made, they talked a little bit about compliance policies and procedures, and they just made the notation that the advisors didn't have or they didn't implement policies and procedures, concerning, how you review and approve advertising, when you use composites, how you determine the parameters for accounts that are included or excluded, and just confirming the accuracy of some of the performance results, all in accordance with the advertising rule. I want to make a note here. I think this theme of compliance policies and procedures, whether it's the advertising rule, performance reporting, other areas of the Advisors Act extending into, our ERISA practice that we have, many of you are familiar with. I think we're living in a day and age when it's becoming more and more apparent that, to not only adopt a rigorous set of policies and procedures to demonstrate that you're satisfying whatever terms and conditions or standards are applicable is really, really key, and the regulators are looking for it, and not only adopting these policies, but adhering to them and following them. So, slide, please. Then they kind of finished out on the, the other things in this alert. They summarized some of their findings from the touting initiative. And again, that was, they were looking at, excuse me, RIAs that were, talking about the awards they have or how they were ranked or their professional designations, their initials after, the name of the firm. And there was a lot of concern here. They found that kind of what they felt was a misleading use of third-party rankings or awards. They found that some RIAs had advertised certain accolades that were earned by submitting, potentially false or misleading information. Some of them were just outdated. Some of the rankings and things were accurate, but they were so dated they were no longer really applicable. They didn't really disclose the relevant selection criteria for these awards or who gave the award, or that maybe they'd even paid a fee to participate in or distribute the results of the survey. And they had some concerns around professional designations. I think this ties in a little bit to what we have now under the rules for Form ADV Part 2B. And some of these things, designations might have lapsed or minimum qualifications weren't maintained. And, of course, they're always concerned about testimonials from clients. So those were some of the areas that they were concerned with that were spoken about. And I think that pretty much summarized what we had in the advertising rule. So I think what we'll do now, if it's okay, I'm going to ask Liz to take over again. We're going to talk a little bit about performance reporting, big picture, and then we'll dig into a little more detail on some of the subtopics within performance reporting.
Right. Thanks, Steve. So in light of what Steve was just highlighting in terms of the risk alert, in light of the fact, that a full half of the problems had to do with performance reporting, I think a discussion about performance reporting is very timely. We're going to start this section of our talk by giving you some background on performance reporting. Then we'll talk about misleading practices relating to the use of model and actual performance, and then we'll talk about portability and back-tested performance. Okay. So the framework for performance reporting is the general anti-fraud rule and the advertising rule thereunder. They do not contain any direct prohibition concerning the use of performance per data in advertising, nor do they articulate how past performance must be calculated. Rather, the litmus test turns on whether the advertising of performance is false or misleading. The advertising rule governs advertising, including performance advertising, whether based on actual results or from trading in a model portfolio. The guidance from the SEC has evolved over the years, and today's performance reporting guidelines have been established by the Clover Capital Management No Action Letter that was issued in October of 1986. The Clover No Action Letter was issued in response to Clover's request concerning its use of model portfolio in advertisements. Now, prior to the Clover No Action Letter, the SEC took the position that the use of model or actual results in an advertisement was per se fraudulent. Since Clover, however, the SEC has used a facts and circumstances approach. It has said in Clover that the use of performance results is false or misleading if it implies or a reader would infer from it something about the advisor's confidence or about future investment results that would not be true had the advertisement included all material facts. While Clover only requested assurances with respect to the use of model portfolios, the SEC took the opportunity to articulate the advertising practices it believed were prohibited by the catch-all against false or misleading advertisements. It is important to note that the guideposts articulated in Clover are not a safe harbor and do not contain an exhaustive list of factors to be considered. Now, specifically, the Clover No Action Letter provided the following practices would be misleading with the reporting of either model performance or actual performance. 1, failing to disclose the effect of material market or economic conditions on the results portrayed. 2, failing except under certain circumstances to reflect the deduction of investment advisory fees, brokerage, or commissions, and any other expenses that a client would have paid or actually paid. This is the so-called net of fees requirement. 3rd, failing to disclose whether and to what extent the results portrayed reflect the reinvestment of dividends and the other earnings. 4th, suggesting or making claims about the potential for profit without also disclosing the possibility of loss. 5th, comparing results to an index without disclosing all material factors relevant to the comparison. And finally, 6th, failing to disclose material conditions, objectives, or investment strategies used to obtain the performance advertised.
You know, I think it's fair to send us an ad that I think that even though there are a lot of refinements and nuances and additions and what have you to Clover, it's still the gold standard. I mean, it still is pretty much the basic template that frames a lot of the analysis for these issues, and it's still very relevant today. Even though that was 1986, right? So it's been around for a while.
Right. Okay. Model performance. So Clover also identified 4 practices considered to be misleading with the reporting of model performance. 1, failing to disclose prominently the limitations inherent in model results. 2, failing to disclose, if applicable, material changes in the conditions, objectives, or investment strategies of the model portfolio during the period portrayed and the effect of those changes. 3rd, failing to disclose, if applicable, that some of the securities or strategies reflected in the model portfolio do not relate or relate only partially to the services currently offered by the advisor. And 4th, failing to disclose, if applicable, the advisor's clients actually had investment results that were materially different from those portrayed in the model. Finally, Clover also identified the following misleading practice with regard to actual performance, which is failing to disclose, if applicable, that the results portrayed relate only to a select group of the advisor's clients, the basis on which the selection was made, and the effect of this practice on the results portrayed. Steve, I'm going to hand it off to you.
Okay. So, just sort of continuing on here, with net of fees, as you've heard, as a general rule, advertising performance requires that you must deduct advisory fees, brokerage fees, commissions, any expenses that a client paid. This net of fees concept has been around for a while, and it gets its strength. It's required because it's doing something. Doing anything else would really, potentially fail to reflect the impact that fees might have on performance and the compounded effect on performance of not deducting fees. And the SEC has always felt it was inherently misleading and inappropriate to go in this way, because the average investor would make an inference about future returns that wouldn't be true if the advisor had presented returns, reflecting the deduction of fees. But there are a number of exceptions, because people like to report on a gross and a net basis, and there are some different aspects to it. So over the years, the SEC has kind of carved out some different, interpretations around this. And one, I think this involves what we call, side-by-side presentation, where you're showing gross and net side-by-side. So an advertisement that presented, composite information on both a gross and a net of fee basis, presumably would be okay, as long as the gross and net of fee performance is presented with equal prominence. In other words, just visually, the ad is formatted and presented in a manner that it's easy for the client to make comparisons between the two, and that the advertisement has appropriate disclosures to make sure that the client knows that it's not otherwise misleading. And I think another area that they've clarified on has been on custodial fees. So the SEC issued a no-action letter, after Clover, and where they sort of reaffirmed that performance results, have to be advertised net of fees and expenses, but they clarified that fees charged by a custodian, to maintain the account, need not be included in this category of fees and charges, because it was the client and not the advisor that usually selects and pays the custodian. So they kind of carved out the treatment of custodial fees. They also, refer to, I guess I'll call it an exception, one-on-one presentations, or, the wealthy client exception. It's very similar to what we have recently in ERISA with the independent fiduciary, kind of expert carve-out for fiduciary status. So one of the things that they said here was that you can present, in a one-on-one presentation, you can present gross of fee performance returns in a one-on-one to certain prospective clients, and that these are people that are in a position to really understand their fees. They're in a position to negotiate their fees. Examples would be, high net worth, wealthy individuals, institutional investors, endowments, universities. And the SEC has said in their no-action guidance that, because these clients have bargaining power over the fees, which is really material, they think it's okay. And a presentation, is deemed to be one-on-one if it's private, if it's confidential in nature, it's not provided to, multiple parties or to the masses. And the prospective client is given, really has a chance to discuss and to negotiate the type of fee that might ultimately apply. And these one-on-one presentations, by private, it means that they're not publicly available. In other words, you can't log on and get a sample presentation on the net, or you can go to YouTube, or any other print or other medium. So these gross of fees presentations then are going to be okay, where the performance disclosures, they don't reflect the deduction of fees. The client's return, as long as the clients understand that the return will be reduced by the fee that's ultimately charged, the fees are properly described in the Form ADV, and maybe, there is included a representative example that shows, how the fee is going to be calculated, over a period of years and how it could impact the value of the portfolio. So up until now, we've been discussing the general rule and the exceptions, around performance advertising. Now we can talk about some other variations here. We can talk about areas where performance reporting is permitted to reflect the deduction of a model fee rather than the deduction of actual fees. And, performance advertising might show that the deduction of a model fee, as long as the resulting performance is no higher than the performance that would have resulted if actual fees were deducted, and the performance data is accompanied by disclosures. And these disclosures would be that the performance reflects the deduction of the highest fee charged to a customer employing that strategy during the period. Fees might vary depending on, the size of the portfolio, for example, and that advisory fees are otherwise, available and can be found in Part 2 of Form ADV. So some advertisements, that also allow model fees to be deducted, situations where you have composites that are both wrap and non-wrap accounts together. These might be meta fee performance using actual fees, and a model fee from the non-wrap account, which is equal to the highest fee charged to a wrap account. Again, as long as you have disclosures here that are sufficient. And you also might have model fees allowed, to be part of the advertisement, where if you have a composite that includes advisory accounts that consist of a portion of the assets of a multi-manager account, meaning fund-to-fund type deals, these can be presented, on a net fee basis after deducting, the fees and the costs that relate to the assets, that are managed by the advisor, including, transaction costs and so on, provided that it's accompanied with the statement that identifies, the fees and costs that have been deducted. Slide, please, up to portability. So, as you can see, there's a lot of there are a lot of rules about reporting on a gross basis, net basis, models, hypotheticals, actual fees, all very fact specific. But we're lucky in the sense that there are a lot of advisory, no action letters here that can really help us. I think we're getting a lot of questions these days about performance reporting, and particularly about portability, and I think there's just so much activity going on in the investment world right now. People are on the move, changing, moving from one firm to another, or firms are being acquired, or forming new associations, joint ventures, what have you. So technically, if an advisor moves from firm A to firm B, well, that means you're going to a new place, and the question is, can you bring his or her background of performance with you? And a lot of the way a lot of firms are being restructured right now with joint ventures and strategic alliances, kind of creating a new entity, maybe a legal form. And the question becomes, to what extent can you claim some of your past history? So this is an area that's always been of interest, and it clearly remains of interest now. And the SEC has issued some guidance here, and I think what they're saying is that it's okay under certain circumstances. You can kind of take your history with you for advertising if you're dealing with the right person, what they refer to as primarily responsible person. What that means is that the person or the persons who, used to manage the money were primarily responsible for achieving the prior performance results. You really identify who managed the money and whether they're part of the new regime or not. There has to be a similarity of accounts. Accounts managed at the predecessor advisor have to be of the same nature and characteristic as those that are being currently managed, so that the performance would be relevant to a prospective client. You have to include all the accounts. You want to make sure that all the accounts are managed in a substantially similar fashion as advertised. You want to make sure that whatever you're doing, in terms of past performance or mapping it over to your current situation, that everything is done consistent with Clover and all the other SEC guidance out there, and that the advertisement also, these advertisements and these communications also have the proper disclosure, I guess would be the word, the right disclosure, according to, to SEC standards. So I think this is really important, and record keeping, that you've got record keeping in place for it. Slide, please, on backtested performance. I want to talk this very quickly. A lot of times people would like to talk about backtesting. I think the bottom line is, it's not per se, it's okay. It's not necessarily misleading. It's not automatically misleading, but, and we can just leave it right there, but it still can be a pretty tricky area. Backtesting performance, requires that you're taking hypothetical performance, you're looking backwards with a retroactive application of a strategy over a certain time period. And the SEC has really been generally suspicious of this over the years. And some of the things that they've called out that they haven't liked about it, they found instances where the backtested performance was derived from what they said was the retroactive application of a model developed with the benefit of hindsight. So here the labeling, labeling something as pro forma or hypothetical in and of itself, isn't enough. Just the limitations of data, the inherent limitations of data derived from retroactive application of a model, and that can be a problem. Whether a trading strategy retroactively applied was even available during a prior period, the fact that actual performance of client accounts was materially less than the advertised hypothetical results, all these things, give the SEC pause. So this is an area that takes a lot of very careful disclosure and analysis when you're putting it together. The SEC doesn't really like it too much, and they've stated, just general, broadly worded disclaimers that say that, the typical language about, a future result, based upon past performance cannot be guaranteed. Just making that kind of statement in and of itself isn't going to be enough. Next slide, please. Clearly, they talked about record keeping in this investment alert, and record keeping, of course, is always important anyway. So, generally speaking, the advertising rule has specific record keeping requirements to keep in mind, and I think this documentation and record keeping is clearly part of the new regime, I think, these days in terms of where the efforts are being made. I think every advertised performance, whether it's based on an actual or model, requires an underlying support from a record-keeping basis. So advisors have to retain all the accounts and the books, the papers, anything that's necessary to form the basis that demonstrates the calculation of the performance or the rate of return of their accounts or recommendations that they're making. And this is really key. That's basically is what the advertising rule is all about, where it goes to 10 or more persons. There is a safe harbor in the rule, and an advisor is deemed to satisfy these rules if you keep the account statements so long as they reflect all the debits, credits, and other transactions to the account for the period of the statement. You have all the worksheets that are necessary to demonstrate the calculation of the performance or the rate of return. So when you're keeping these account statements, you have to be able to demonstrate that they've been prepared contemporaneously with the period reported, not done, in hindsight. And all these statements, whether used in the computation of the performance figure or not, must be kept. So record keeping is something that's really important. We have electronic records now. You need to have backups on them. You need to be usually for, I think 5 years, the first couple of years in the advisor's office itself. And you need to have a really good section of your compliance manual that addresses record keeping. So that's another area that was called out, and I think that's something that they're always talking about, just generally going in on exams and audits. We always tell the same thing to our, to all of you or to our clients. Document everything. It's one thing to say you're doing it, but you need to have good files and all your interactions, all your work to show the effort that you put into meeting the standard or meeting the term and condition of any rule or regulation, just tracking the advice you're giving clients, tracking your data. You need good files. I think the final topic that we're going to talk about today is the global investment standards, GIPS. as it's called. And these are voluntary standards. You see them all the time, because, the SEC, for all the discussion that we've had about anti-fraud and advertising and how to calculate returns, net and gross and so on, there really is no specific SEC rule, or even at the state level, and there's no specific FINRA rule to the extent that it's a good benchmark, that really gives specific requirements on how to satisfy presenting investment, performance information to clients. So what happened over the years is the trade groups picked up. The predecessor to the CFA, now the CFA, developed a set of standards, and ultimately these came to be known as the Global Investment Performance Standards, or GIPS. And some aspects of these, might be mandatory for an advisor that says they're complying. Others are voluntary. But in general, these standards require that presentations of investment performance, follow some general practices. They're very focused on, they like to see total return to calculate performance. They like to see the time-weighted value of money, the time-weighted rates of return with at least a quarterly valuation. They like to see cash included in the return. They definitely favor accrual, not cash accounting. They like to see accounts, in a composite. In other words, all the fee-paying portfolios in at least one composite report. They do not like or support the notion of linking, model portfolios with actual performance. There's a certain limitation on the portability of portfolio results that are baked into these standards. And they like to see a 10-year performance record, or if it's shorter, since inception. But that would require certain exceptions to be made. So these standards are really helpful. A lot of people talk about them, and it's important to note that they're voluntary, and they're really not part of what the SEC does. It's a different. It's not really derived from SEC no action letters or regulations. Let me just throw out a couple of things, maybe just quickly to round out the discussion, on some of the differences between the SEC and these voluntary standards. Well, for one thing, the SEC applies to everybody. You can be a current client or a prospective client or a prospect. The SEC would view you in the same boat. These voluntary standards are used for prospective clients. That's where they really apply for advertising, for the future. And they, the SEC says that, disclosure and content might vary based on the audience. You have a little bit of leeway with sophisticated clients, but on these voluntary standards, what you're looking for is just to have a compliant presentation with regard to all the standards. It would be uniform to everybody. There's no distinction, and you'd have to update them at least once a year. You don't have to show them to existing clients. An existing client could qualify as a prospect for a new strategy. So there's a distinction there. I think prospects and clients for the SEC, prospective clients under the voluntary standards. The SEC really, as you know, leans heavily toward net returns in advertisements. These voluntary standards allow for gross or net, and in some ways they think that gross might even be better because it shows better comparability between the firms, because everyone's expense trail can look a little bit different. But it's pretty common, I think, on the voluntary side to include both gross and net returns in a compliant presentation. On the SEC side, net returns, the SEC, they say you could deduct actual fees or your highest standard fee. On the voluntary standards, it's a little different. If you're using model fees, net returns have to be lower than net returns that are calculated with actual fees. And typically what you do is you take a model fee and divide it by 12, right, one for each month of the highest tier of the applicable schedule for the monthly composite, things like that. The SEC says, nothing can be false or misleading. You have to use current returns. The voluntary standards, they talk about only annual returns being included. They have to be updated annually. but there's not a lot of guidance as to how soon after the year end or what other period of time, you know, a new return would have to be included. So there are some differences here, and I'm simply making the point that the SEC, there are no hard and fast rules. You have to kind of divine all the learning about, you know, cherry picking and composite and gross and net and come up with something. The voluntary standards are actually a little more well articulated, but they apply under a different set of circumstances. And clearly, when you're referring to one or the other, you need to be very careful as to how you're, you know, calculating and ultimately making disclosures. So I think the point of all these topics that we've discussed is that the advertising rule, the anti-fraud rule, the concept of deducting fees, gross or net, how to report, back testing, hypotheticals, portability, you know, these rules have been around for a while. These issues have been discussed for a while. And to the SEC's just surprise, really, as they reported back a few months ago, they found a significant lack of compliance or significant weaknesses in these areas. So I think our takeaway here for you and what we've been talking about with our clients has been that this is probably a very good time to self-assess where you stand in terms of your advertising, your communication with clients, whether it's electronic or written, how you're calculating returns, to the extent you use them as a tool to talk about your firm and to gather assets, what your record keeping looks like, what your documentation looks like, and to make sure that you're in step with the current spirit of enforcement, which is coming from the SEC in this area. And on a parallel basis, in many ways, we see it with FINRA and the Department of Labor as well. So on that note, I will thank you for listening in to our webinar today. I hope it's been interesting. I hope it has stirred you to take a self-assessment, take a fresh look at what you're doing with your advertising and your performance reporting, and see if you're up to speed with the current trends and requirements with all the documentation and processes and procedures that are in place. If you have any questions, Livia and I would be glad to help you. Please just contact me in the Wagner office. I'm in our San Francisco office, and Livia and I would be delighted to assist you and give you any further support that you need, or just answer your questions and try to point you in the right direction. So thank you very much for attending the webinar today, and we'll see you again in a couple of weeks with our next scheduled webinar, for which you'll be receiving information shortly. Thank you very much and have a good day.